Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Eastern Airlines Corporation Limited Annual Report. China Eastern Airlines Corporation Limited offers a wide range of businesses and services to cater to various needs of its customers. At the core of its operations are air transportation services, including passenger, cargo, mail, and baggage transportation. The company also provides general aviation services, which include charter flights and other specialized flying activities. In addition to these primary services, China Eastern Airlines offers a variety of related businesses such as aircraft maintenance, manufacturing, and equipment maintenance. It also acts as an agency for domestic and foreign airlines, facilitating travel arrangements for its customers. Furthermore, the company is involved in tourism services, hotel business, and other air transportation-related activities. The corporation's scope extends beyond traditional aviation services to include engineering, training, and research and development in the aviation field. Its subsidiaries also provide investment, leasing, and consulting services, as well as e-commerce and ticketing agency services. China Eastern Airlines has ventured into value-added telecommunications and produces and sells aviation gifts and general merchandise. With a fleet of 826 aircraft, China Eastern Airlines Corporation Limited is one of the leading airlines in the world. Its extensive range of businesses and services makes it a comprehensive provider of air transportation solutions, catering to various needs of its customers. China Eastern Airlines Corporation Limited maintains a market capitalization of $85 billion, broadly in line with the industry peer group. China Eastern Airlines Corporation Limited trades at a higher price-to-book ratio of 5.86 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 87% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, expansion of domestic routes and launch of new air routes have contributed significantly to revenue growth. Additionally, market expansion has led to an increase in transit passengers via Shanghai by 17.5% year-over-year. The introduction of innovative products and services through campaigns such as Civil Aviation Services Boosting Consumption Year has also driven revenue growth. Furthermore, the company's membership system, particularly the high-quality services membership rating model, has seen a significant increase in members, contributing to revenue growth. International routes have also experienced a notable increase in passenger traffic volume, with a 22.69% growth rate. The company's diversification into various services such as financial services, catering-related services, and freight logistics business support services has also contributed to its revenue growth. On the other hand, the primary drivers of revenue decline are less clear-cut. However, it appears that a decline in other revenue by 3.22% is one factor contributing to revenue decline. Additionally, CEA Wuhan experienced a revenue decline of -6.3% from 2024 to 2025. Overall, the company's ability to adapt and diversify its services has been a key driver of revenue growth. However, it also faces challenges in certain regions, such as CEA Wuhan, which requires attention and strategic planning to mitigate revenue decline. The company's net income experienced a significant turnaround between 2021 and 2025. Initially, the company reported a loss of 12,142 million RMB in 2021, which improved to a loss of 4,226 million RMB in 2024. However, by 2025, the net income had further improved to a loss of only 1,633 million RMB. The improvement in profit margins was also notable, with the company reporting positive profit margins in both 2024 and 2025. This marked a significant shift from previous years, where profit margins were negative. The operating income increased by 139% between 2024 and 2025, indicating a substantial improvement in profit margins. The reasons behind these changes can be attributed to several factors. Firstly, the company's operating results showed significant improvements, accompanied by record highs in traffic volume, passengers transported, and cargo/mail transportation volume. Additionally, revenue growth from market expansion contributed to the positive trend. Furthermore, increases in cooperation routes income, gain on disposal of assets, and other subsidy income also played a role in improving the company's financial performance. The company's financial performance indicates a positive trend in its operating cash flow. The net cash generated from operating activities has been steadily increasing over the years, with a notable jump to RMB 37,941 in 2025 compared to RMB 37,314 in 2024. This significant increase suggests that the company is efficiently managing its operations and generating substantial revenue. Furthermore, the summary on page 165 confirms this trend, stating that the net cash generated from operating activities reached a high of RMB 37,987 million in 2025. Additionally, the net operating cash flow has also shown an upward trajectory, reaching RMB 2,220 million in 2025. These figures collectively indicate that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. And the company's debt level has undergone significant changes over the past year. Initially, the total financing reached a record high of RMB 30.5 billion, with no comparable figure for the previous year. However, subsequent pages reveal that the total debt level decreased by 1.34%, and the current portion of borrowings also saw a decrease from RMB 49,576 million to RMB 49,411 million. Notably, the debt-to-equity swap for Hainan Airlines Holding increased significantly, indicating a shift in the company's financial structure. Furthermore, long-term bank loans increased substantially from RMB 10,500 million to RMB 38,753 million. On the other hand, non-current liabilities saw a decrease in borrowings, but an increase in lease liabilities. In terms of interest expenses, there are mixed signals. Initially, interest expenses decreased by 18.71% year-on-year, and then increased by 228 million RMB due to a 25 basis point rise in floating interest rates. However, subsequent pages reveal that interest expenses have continued to decrease, with a notable drop of RMB 7 million from 2024 to 2025. Overall, the total interest expense has increased by RMB 1,663 million, 29.7%, from 2024 to 2025, indicating a significant change in the company's financial obligations. The financial performance of the company's various segments and regions has been mixed. The airline transportation segment was a notable underperformer, with significant losses reported in both income tax and reportable segment revenue. In contrast, other operations segments showed strong growth, with high revenues and profits recorded on page 107 and 108. However, it is worth noting that the China region appears to be performing well, as evidenced by its high share of result of joint ventures. This suggests that the company's investments in China are yielding positive results, which could be a key driver of future growth. Overall, while some segments and regions struggled, others showed promise, highlighting the need for targeted investment and improvement efforts. Management's outlook for the company is one of growth and expansion. The group aims to optimize its risk management by minimizing RMB financing costs and enhancing research on projects. This will enable the company to expand into new international markets, further diversifying its operations. In addition to this, management has prioritized digital transformation and construction as key areas of focus for long-term development plans. Specifically, they are implementing key projects such as the China Eastern Airlines base at Xiamen Airport. This strategic investment is expected to drive growth and enhance the company's competitiveness in the market. Management also views its equity investments as strategic, indicating a commitment to building strong partnerships and expanding its presence in new markets. They believe that the estimated fair values of these unlisted equity investments are reasonable, suggesting confidence in their potential for long-term returns. Overall, management strategy is centered around growth, innovation, and strategic investment, positioning the company for future success. The company has made several significant acquisitions in recent years. In 2025, the company acquired aircraft, engines, and flight equipment for a total of RMB 78,867 million. Additionally, other property, plant, and equipment were acquired for RMB 5,152 million. The company also invested RMB 3 million in various assets. These acquisitions demonstrate the company's commitment to growth and expansion. By investing in new aircraft and equipment, the company is able to improve its operational efficiency and increase its capacity to meet growing demand. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to its shareholders. As per the records, the company has indeed paid dividends, with clear documentation available on pages 98 and 192. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares. The company's decision to buy back shares is evident from page 15 of their annual report. That concludes the financial summary for China Eastern Airlines Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.